Well, good afternoon, everyone. It's great to see you. We're going to talk a little about economics today. So no, I'm not Adam Sachs, but I am his understudy on this one. So the title of this presentation is Defying Gravity, or Can the Travel Industry Defy Economic Gravity? And there, we're going to go backwards. All right, so let's start. You know, what is gravity, right? It is essentially the interaction of two masses. And so when you think of gravity, you think of the gravity that keeps us on Earth. It is the gravitational pull. It's two masses, either a planet and the Earth interacting with each other. But for the industry, I think you have to think differently. And what we're seeing right now is some concurrent effects that is driving our industry in various different ways. And you're seeing it in the various chain scales. So the first slide you're going to see is like, you should be shocked. Since April, we have seen RevPAR, inflation-adjusted RevPAR, decline. So right off the bat, you're starting to sweat and go, oh my God, are we heading down a path? Are we heading south now? Are we no longer moving north? Is there something really that we need to be afraid of? The only good thing in this chart, when you look at it, is you can see on the nominal and even on the real side, you see that it's starting to move up just a little bit. So it's not as negative over the last 2 months as it was in December. Then you start thinking about room demand, and you say, okay, what's going on? Why is RevPAR going down? When room demand essentially is still in recovery, it looks like it's very close to where it was prior to the pandemic. And then that's when you really start having to think it through and go, okay, some other forces are at play that we really, in the way we look at economic data, you almost have to segment and think differently and get away from general economics, and what I like to think about is travel economics. So first, we're going to dissect demand a bit. When you look at demand has fallen, like RevPAR, in every month since April. And what's more concerning on this slide, as a forecaster, is the last 5 months. Because if you've seen the STR forecast that we released in January at the Alice conference, we're still predicting RevPAR growth in 2024 and in 2025. But this would lead you to believe like, oh, there's something afoot, and there's no way, given that real RevPAR is trending down and nominal RevPAR is really low. So what's happening with consumers? That's where we're going to start. What are consumers thinking? The conference board obviously produces their monthly conference consumer confidence report. And what I started looking at here is, first of all, overall consumer confidence is above 100, above the benchmark, but below where it was prior to the pandemic. But what's surprising to me is the present situation is still pretty strong, and it's trending upwards. So essentially, consumers are feeling okay. There are some, concern about the future. Expectations are still low, not above the benchmark, and they're continuing to be, it hasn't really moved very much. But again, I'd looked at this as, okay, consumers are feeling, okay, somewhat good, somewhat content. And then I start looking at the employment situation. I first start looking at layoffs. Layoffs, when you index them back to 2019, prior to the pandemic, are still below where they were. Yes, there's been high publicized layoffs in the tech industry, and there are still some concerns about layoffs, but overall, they're still much lower than they were prior to the pandemic. And then job openings are still higher than they were prior to the pandemic. Albeit, some of the job openings that are available right now probably won't help our industry. They're lower paying jobs. So again, yes, it's high, but maybe not necessarily something that will be a catalyst for the travel side. And then overall, you put the picture together and you look at the dotted line, if you can see it, it is above where we were in 2019. Essentially, we have more people employed today than prior to the pandemic. Okay, so that looks good. So again, demand is down, job market looks healthy. What about what people are spending money on? So when you looked at the consumer spending, you saw in the fourth quarter it actually rose. And so again, pretty good consumer spending amount. But again, that's the general side. I want to look at what people are spending on accommodations and how that compares to services. And what you see on the right-hand side is you see that accommodation spending is essentially above, slightly above, what people are spending for other services. This tells me, again, that the desire for travel is still there. Again, what we've learned through the pandemic is that it really encouraged or accelerated people's desire to be with other people, to see new things, and to, again, travel overall. So again, this kind of proves that out. And again, what's interesting right now is that it did pop up a little bit in the most recent report. But there is some other mitigators. We know that people have less money now in savings than they did. So savings rose during the pandemic and now essentially are back to where they were before the pandemic. But I focus in, again, this is where I start thinking about the travel economy, how it's different from the general economy. I believe, and it may be a bias on my part, the way I grew up in the financial situation my family was in, that it's really higher income individuals that do the bulk of traveling. Again, Adam Sachs had a chart on that. We couldn't find it. He and I were talking yesterday trying to find that chart that shows the proportion of travel by income group. But here what this shows you on this slide is deposits at higher savings rates really was still mostly centered in those higher income groups. So again, these are the folks we need to start watching and see, okay, what's happening in this group? And maybe that's why we're seeing concurrent differences in our industry. And we'll talk about that in a little bit when we get to some chain scale data. But again, it is a reality that inflation has been around, and so real personal disposable income has taken a hit while inflation was going up. But again, in the most recent months, beginning in June 2023, of the second quarter, you can see that it's been higher than the rate of inflation. So again, as I keep looking at this as a forecaster going, what is going on? Why are we seeing this downward pressure on RevPAR, this downward pressure on room demand, when again, these signals seem somewhat positive to me. Not greatly positive, but still positive. Well, again, what we're seeing is maybe people are living beyond their lifestyle or trying to keep up with their lifestyle, and again, putting a lot more on their credit cards. So what you see on this slide is the increased credit card debt, and it's come up really high. I looked at it over the entire series that the Federal Reserve Bank of New York has, and again, these increases are among the highest we've seen. So again, now that's something we need to start watching. So debt is on the rise. And if you could look at debt to income ratios, I would suspect that those ratios would show that lower income individuals are being more impacted with the rising debt. And of course, rising interest rates. But then you look at the travel side and you go, people are flying more than ever before. So now you're gonna get mixed messages going, this is data from the TSA, and this is screenings, and we use it as a proxy for travel now, and you can see that it's well above where it was prior to the pandemic. So room demand is down, air travel is up. That should be your first indication, again, that something is afoot, and it may be economically related, and that is, when you look at the international outbound and inbound, you see international outbound is rising tremendously. The February number, which just came out, was staggering to me. I didn't expect that. This is indexed to 2019, but this is starting to tell me that, again, that it is the tale of two cities, if you want to talk of it that way, that lower income individuals now are being impacted more than higher income individuals. So those people that are predisposed to travel still have the means and are doing so, but maybe on the lower end of the tier, we're starting to see that impact, where again, high inflation, high interest rates, and high debt. And in fact, when you look at that chain scale, that's where you see the impact is. Again, it is all in the economy sector at this point and somewhat in the mid-scale sector. I've been focusing a lot of work that I've been doing at STR is looking at the economy sector, trying to really dissect, and many of you in this room, we've had lots of conversations trying to really understand what has happened here. One piece of the puzzle is closures. So what the idea here is that we've seen more closures of economy hotels than we have in the past, and that demand that was associated with those hotels has basically disappeared. Rachel and I, Rachel Rothman of CBRE, just had a conversation this afternoon. We think part of this is as rents have been lowered for apartment buildings, these people they weren't displaced, they just left these hotels and now can afford to stay in hotels. That's, apartments. That's just a piece of it, we think. We also think there's a lot of changes in terms of contract businesses who used to use economy hotels that may be moving. Again, lots of different reasons. But again, one thing we can point to is, again, closures has actually gone up. And again, that demand, some of the work we've done is to try to estimate how much of the drop in economy was related to closures. And it's bigger than you think. And again, on the right-hand slide, you can see how many hotels there are in economy versus where we were in 2018 and 2019. And again, part of my thinking is, again, it is economically related. Here's another way of looking at total debt. So we know everything costs more, so I adjusted it for inflation, but you can see, again, debt is rising. Total debt's rising. Mortgages, credit cards, automobiles, et cetera. It's all going up. But what's more important to me when I'm looking at all these numbers, Again, great, debt's going up. We know everything costs more than it did 2 years, 3 years, 4 years ago, but I went to look at the delinquency rates. And the delinquency rates is what caught my eye. So this is long-term delinquency, or not long-term, but longer or mid-term delinquency, 90 days plus, and again, it is rising. And I indexed this to 2019 again, so it is higher. It's 20% higher than what we had prior to the pandemic. So then when you put it all together, what you see again here in this slide, kind of finishing this section, is again, it's on the lower tier where the demand side is being impacted the most. And then the upper side, the upper tier, is doing okay, still growing demand, so it's still in recovery. I think what's interesting also about this slide, and I didn't do any work on it yet, this is my next project, will be that gold portion, the upper mid-scale, to see, okay, now we're seeing some impact, some bleed through in the upper mid-scale, and I think it's worth, I'll be looking to that as in the months to come or the weeks to come to see if we can understand where that's at, and is that just a natural change that, again, the upper tier is doing well with groups and meetings, while the lower tier continues, including all lower tier, starting to slide a bit. So given that, so we have all these mixed signals, why is SDR optimistic about the future? When you see our forecast tomorrow in the panel at about this time tomorrow, you'll see our forecast that we presented in January in Alice, and again, you'll see RevPAR growth, and we're still predicting RevPAR growth. But again, if you could when we were preparing that forecast, we had seen the weakness in economy and mid-scale. So that's actually built into it. But the question is it going to get worse? Are we going to lower our forecast? Well, let's look at the data, what we're looking at right now, and how we'll impact that forecast. First of all, GDP is expected to come down globally. But in the US, it's changed now. Basically, if you thought last year was good, this year will be good. So all your perspective, about 2.5% GDP growth. But in other parts of the market or other parts of the world, you're going to see declines. So again, globally, there is some movement and some change that could impact inbound. But for our forecast, for the GDP forecast here in the US, we've seen substantial revisions. So when we released the January forecast in January, we expected about 1.2% GDP growth. With the latest release from Oxford Economics that came out on Friday, it's now closer to 2.5. So if you believe there's a relationship, and if you built the model, and the only thing you built the model for demand was GDP, and you believe that relationship, then you'll expect demand, our forecast, will go up. And when you look at that relationship, you can see how tight it's been in the past, GDP to hotel demand. And what we're seeing for the future is there's still room to catch up, right? We know we haven't gotten back to 2019 levels. So again, this is giving an indication that, yeah, I think you will see some revisions to the forecast. I can't tell you what they are because we haven't started on it yet. Of course, we will take into account the time series of all the hotel segments as we're building the forecast. But again, right off the bat, if you only had a single model and this was the way you forecasted, you would expect demand to continue to move upwards. And again, why are we so optimistic? And some people think I'm optimistic. I try to look at the data. I am an optimistic person at heart, but we're also looking at lots of data. And my optimism comes a lot when we're talking internally of these charts here. First of all, total employment's going up. That's a good thing. But more importantly, what we've seen since the end of the pandemic has been the growth of professionals. That's the sector of the employment spectrum that's seen the largest growth. Why is that important? Why do I think that's important? Well, I believe the professionals are the ones that, of course, they tend to be college educated, and they're the most likely to travel business and leisure. So I continue to watch this sector. I watch it on a monthly basis. I look at it each time the data comes out to see what's happening there. Because again, this to me, they are the most predisposed, again, to travel. And I think that's a good thing for our industry, and it's been great to see that growing. At the same time, our forecast calls for increased unemployment, which seems kind of odd. You have employment rising, but you also have unemployment rising. What's going on? Well, essentially, the total labor force is growing faster than the employment. And so because of that, you're going to see that unemployment. But again, okay, that's the general side. What I focus is on the things that matter to the industry, to the hotel industry, and that's why I look at unemployment by level of education. And when you look at the level of education, I specifically look at college educated. Again, I use it as a proxy. These are the people that have the means and are more predisposed to travel for business and leisure. And again, if you forecast that out, this is a forecast that we do internally at STR, you can see that we expect, again, college-educated individuals, their level to be pretty low still. And again, we watched this carefully because in 2008, you could see that movement. So in 2008, when we were entering the Great Recession, you saw all the layoffs and you were starting to see that move up substantially. So right now, we're not seeing much movement. We expected to move a little bit because again, unemployment is gonna go up, but overall, again, it looks minimal and again, very supportive for the travel industry. The other thing that I've been thinking a lot about, and again, what's really interesting about all this data, again, we use Oxford Economics as our data source, and again, they're our partners, and the forecast that STR does, Tourism Economics. What I thought was interesting, when they were forecasting the recession last year when Oxford was, they were also had these charts and this data showing an increase in 100,000 plus households, and then rise in personal disposable income. And I thought that just kind of contradicted why would GDP fall. And again, why is this important? Again, these are the people that will have the means to travel. And again, I go back to that theme. These are the folks and these are the factors that we look at continuously as we're building our forecast and discussing the forecast internally. And again, it's really just fascinating to see that and just seeing that it's been growing for some time. And then because of that, you know, the higher income individuals are also the ones that are more confident about the future and the present situation. And so when you look at the Consumer Confidence Board and 3-month moving average, and you see that, again, the 100,000 plus, again, no one's back to where they were prior to the pandemic, but again, it's still a very positive situation and higher than the general populace. And then you can also see the group that is feeling the most impact, that's the least confident, again, are the lower income individuals, which makes sense with the rising costs, and wages not keeping up on their side. And given that, we think vacations will continue to increase. And you can see that from also the conference board. You see that US vacations, that 50% of respondents believe they were gonna take a US vacation in the next 6 months. And I did this as a 3-month moving average just to make the lines easier to read. And then foreign vacations are also up. And again, you saw the slide about the outbound, how strong that's been lately. Again, we believe that will continue. Given that, leisure is expected to continue growing. And this data is out of Tourism Economics. Again, very solid numbers in growth, 8% this year, another 4% next year. But what's more astonishing is looking at the index of 2019. Again, if you believe these numbers, again, it was up 9% versus 2019 last year. It'll be 15% higher than 2019 this year by the end of this year, and then 18% higher than it was in 2019 by 2025. And again, I think this really, for me, bodes really well for us in the travel industry overall. Again, this is, again, it's been growing for some time. For those of you who've been in the industry as long as I have, again, leisure really started taking off in the late 80s. Again, before that, there was, you didn't have weekend breaks. You didn't have all the stuff that people do today. Again, today you have a lot of people on vacation. You have more people doing 3 vacations a year than ever before. So again, this just continues that trend. And we think, again, the pandemic just accelerated that trend. Another growing factor, and again, for our optimism, is the business side of it. Yes, this is the piece that hasn't come back, but there is a piece that's been doing somewhat well over the last several months, and that's groups and meetings. So remote working, work from home, has really moved, I think, to a certain degree, the need for more meetings and for conferences such as this. And again, when you look at the data, the gray bars represent 2019, and then the various colors, 23 and 24. And again, I always focus on the gap to what it was in 2019. And those gaps are closing, and several, especially October and November. In October, it actually surpassed 2019, and in November, it was very close. And again, when we look at groups and meetings, we're just looking at luxury and upper upscale at this point. And again, that's the big group houses. It makes it convenient for us to do so. But again, overall, the trends are just very positive on this. And the other thing I start looking at, like economics, again, is what's happening to corporate profits, what's happening to business investment. Business investment was stronger last year than it'll be this year, but it's still positive at 2.5%, growing about basically at the same rate as the economy. So we think that's still very supportive for business travel, and then corporate profits still remains very strong in its growth rate. I must tell you, when we did the January forecast, we had corporate profits for both 24 and 25 growing at 10%. I thought that was a little excessive, so actually these numbers make more sense to me than the previous ones from Oxford. So again, a supportive environment. The other thing I've been watching is small business optimism. Again, small business is the backbone of the US economy. So watching what's happening with them is also a good indicator of what we think will happen to the economy. And again, their optimism is still not where it was prior to the pandemic, and it's still rather low versus where it was, again, to the pandemic. But I thought was interesting, again, we look at this trend line, or these bars, again, the last 3 months are starting to rise. So again, a good indication, hey, maybe there's some positivity going in there, and that will, again, they're having a harder time, like many of you that operate hotels, because all their costs are up as well, right? So again, that's why their optimism would be impacted. But again, it's now starting to go up, and that's a good sign. We also work with Simple View, and they do a lot of work with DMOs, and looking at lead generation, so going back to that groups and meetings. And again, what was interesting in this chart is just looking at the amount of room night leads and then overall leads and where they're going, and going basically to hotels. And I thought that was really cool to see that. And again, this is for all periods of time. It's not for 24 or 25. It could be for any period of time. And this was as of the end of 23. But again, I thought that was good for us to say, okay, good. We're still seeing those lead generations, and they'll continue to hopefully propel our industry in the group side. So putting that together, again, we think that demand for our business trips grow by about 6% in both years. Again, they grew pretty strongly last year. This year they moderate. And what's interesting, even though the headline says fully recovers after 25, the latest data shows that it actually recovers sometime this year and more into 24. Again, I think that's gonna be revised a bit, but overall, there is a thought that, again, and this is business spending. We don't have nights on this in terms of the data that we get from tourism economics. And so again, the spending side will be fully recovered sometime in the next 2 years. And then finally, another positive piece that will continue to drive our industry is the international side. What's interesting here is we thought when we looked at this data, this is looking at exchange rates where they get back to the long-term historic average. We thought, okay, this will probably make it less likely that people will leave the US and stay more domestically. Well, you just saw the February data, and that didn't play out. And so even though, because in the thought process here is basically, hey, if you really want to go overseas and you have the means, exchange rates are not going to be the impediment. They're not going to stop you. You may think about it, but you're not going to stop. And again, for business travel, you're just going to go anyway. And so when you start looking at the departures, outbound departures, you can see that data there. It jumped a lot last year at 31%, but it's still going to be high, increasing by 11%, and then still increasing by 7% in 2025. And that was surprising. And again, this data is coming out of tourism economics. And again, I put on the right-hand side where people are going, and this is just a percent of all departures. The UK continues to be the favorite spot. France, Spain, it's what you expect. And so there's no surprises there. But again, what is surprising is, again, and this is indexing, I should have said that on the data, on the slide, that we are indexing to 2019 on the departure side. So again, what that's saying, it's going to be 11% higher than it was prior to the pandemic. And then inbound, that's going to be a surprise. We think inbound starts coming back. And so again, you can see that also the gains coming through the inbound side overall. But what was surprising to me in this data, and we had lots of conversations with tourism economics about this, was seeing at the top of the list was Dallas and Houston. Why is that? Again, that's because it includes inbound from Canada and Mexico. But when you get down to the very bottom, you look at some of the gateway cities, you can see that LA and New York are still going to be well below where they were prior to the pandemic. So again, it just depends, what the mix of inbound is. So again, there's still room for growth here as well. So again, you've heard my optimism, but one of the things we do is that we're always looking at surveys and say, is our optimism based in something besides the data? Are we just, because we don't operate hotels, right? We're just looking at data. And so unbeknownst to me, tourism economics did a survey. You'll see my survey, because last year I was talking to the team and I said, okay, we have all this data, we do all the work with tourism, but I just want to know what people on the ground really think. Are they optimistic? Are they pessimistic? And so we launched our survey, and at the same time, I guess tourism did the same thing. And what it shows you, again, high optimism for travel. That we truly believe travel will continue to grow, and that we're not the only ones. People actually on the ground think the same thing. And then when I looked at it, I go further, I look at KPIs and seeing what folks are thinking about. And what this shows you is that for 2024, it's evenly split. Our respondents said about a little 45, 46% said occupancy will continue growing in 24, but we also have 51, 52% that said it will decrease. It's almost that's playing out what we're seeing in the data, right? It depends what type of hotel, where you're at. So if you're on the lower end of the spectrum, the decrease is probably real. You're already starting to see it. If you're at the high end of the spectrum, the chain scale, then you're seeing the gains. And I think that's just playing out. But what was more surprising to me was also then seeing the ADR side, that the vast majority of individuals believe that ADR will continue to rise. And the way we asked the question, even though we didn't break it down here, is we actually ask in percentages. And so this is not, we're not intended to mean that people think that rates are going to rise 6, 7, 8%. No, that's not going to happen. But again, overall, they are going to rise. And if you enjoyed the musings I just gave, and you believe me or don't believe me, you should listen to Jan Freitag and myself. We do this every month on our podcast. And so we're about to record our next one here at Hunter. So if you enjoyed what we're talking about, we talk about it again over and over on a monthly basis. And if you have any questions or thoughts, or any feedback of any kind, both positive or negative, if you agree with me or you disagree with me, just send me a note. I'd love to have your thoughts because that's how we learn as well. So again, thank you for your time and enjoy the rest of the conference.